This is Talk with Audrey. Welcome back. As we approach mid-year, a number of forces are creating volatility in global markets, and probably the biggest concern is the ongoing US-China trade dispute. Joining me now with some insight to the global trade and investor concerns, Jean Goldman, the Chief Investment Officer and Director of Research for Cetera Financial Group. Hi, Jean.
Hi, Audrey. Good morning. How are you?
Good morning. I'm great, thank you. And I'm waiting to hear, what the heck is going on with these markets?
It's funny because, we just finished our mid-year outlook, and what we're saying is, to your point, we're calling it mixed signals, because you look at some of the data today, data in the markets and the economy. Some data is cooling, but we're in an expansionary territory. That's mixed. Valuations on stock market, it's fair, but there's a chance that earnings could be lower in the third quarter. Also, you look at treasuries, like treasury yields. We have a very inverted yield curve where we have short-term yields are trading above long-term yields. This suggests that there's some concerns down the road about the economy, but at the same time, in the bond market, you see spreads between riskier debt, very tight, versus traditional treasury bonds. This is suggesting great news down the road. So lots of mixed signals in the markets today. Very difficult for investors to navigate this type of environment.
Yeah, and, navigating the environment, I'm sure for you guys is like par for the course. It's what you do. But for smaller investors, if you will, people who are worried about, maybe their 401ks or just a small investment they might have in a stock or a bond or something, what does that mean? How can smaller investors stay calm? Because what they see is it going up and down, and they don't really have any control, right? It's the big guys who've got all the control. Yeah.
So if I'm a small investor, so we're all small investors. So what I would always do is first of all, given where the markets are, because we're up, the S&P 500 is up, high single digits, high double digits, high teens, great result this year. But now's not the time to be too risky. I would have a very balanced approach. We don't know which way stocks are going to go. Are they going to go up? Are they going to go down? We don't know. What we do know is that valuations are a little high. It's a good time to kind of reduce risk in your portfolio. So if you've done a great job in your portfolio, I think your best bet is to, take some of those gains and make sure you rebalance back to your long-term investment objective. So what that means is that if long-term you're a 60-40 investor, so 60% stocks, 40% bonds, but if your portfolio is now 75-25, take the opportunity to reduce some of the risk and go back to your long-term, your long-term investment objective at 60-40.
So how do you know when to do that, Gene?
I would do we all know hindsight is 20/20, so we know exactly in the past when to do it. But I would look at you look at some of the data. Right now, July is going to be a very interesting month because July we'll have a lot of data. We have obviously the G20 meeting with China and the U.S. We also have a jobs report coming out first week of July. We also have a GDP report. We also have some manufacturing data. We also have the Fed meeting late in July. So I would use the opportunity, constantly. Some people say quarter end. I would say quarter end or every 6 months would be a great time to always reevaluate your portfolio. And obviously, most importantly, try to work with an experienced advisor that can kind of navigate this market uncertainty.
Yeah, working with someone who's experienced is key because I tell you, I tried to go it alone. Oh boy, that's disastrous. Because you just don't know.
Yeah, no, it's tough.
Yeah, go ahead. I'm sorry.
Our own. It's tough because we can be our own worst enemy. Even for me, I still work with an advisor to navigate the market uncertainty.
And so, yeah, so nobody really has any control. You can't control the market. So we're all sort of subject to the whims of what's going on internationally, and again, how the big guys are playing it. Where do you see all of this going? You've got, as I mentioned earlier, the US-China Trade War. How does all of that impact the market?
Yeah, that's a great question. The markets, it's as you said, it's not some person moving the market around. It's always a ramification. So you look at, for example, something as like a point like the U.S.-Iran tensions have increased. All of a sudden, oil prices have moved a little higher. Gold is now at highest level since May of 2013. So there's always an issue that affects that takes place, whether it's weakening data in Europe, whether it's a trade war, and there's always ramifications to the market. That's why, one thing there's a cause and effect throughout the world in terms of markets. So, what we do is, our team, we rely on data. We look at markets. We look at the effects. And to your other point of going forward about what are our thoughts on the market, the only thing that we can accurately predict is that volatility will pick up, because as you've just alluded to, there's so much data out there, lots of mixed signals, and markets are trying to review all that data. Expect a lot of market volatility, fluctuations. But the good news is that long term, since 1933, the average annual return of the S&P 500 is about 9.3%. So we will have some times when markets are up, sometimes when they're down, but the good news is that long term, markets should be positive.
You got to sort of know when to hold them, know when to fold them. Right? No.
You sound like Kenny Rogers.
Not to make light of this, but yeah, so everybody's concerned, of course, about, how the U.S. economy might suffer as a result of the current, trades and tariff situations that are going on. What do you see there? Yeah,
it's a double-edged sword. You're seeing data definitely weaken because of the trade war, because companies are concerned about supply chains, about increasing costs. But at the same time, though, it's also causing pressure on both the U.S. and China to resolve this trade war. The U.S. data is definitely weakened. You're seeing this in manufacturing data. You're seeing this in some consumer confidence and retail. So there's a litany of data you can just look at and point to. China's facing the same thing. Here's an example. Chinese exports through the month of May, year over year, they're up 5.2%. That sounds great, right? 5.2%. But back in October of last year over year, they were up 19.7%. The Chinese economy is definitely being affected by the trade war, as ours is. Both stock markets have been affected. You saw the month of May, trade war rhetoric increase. That hurt our stock market. And then the final point why we truly believe the trade war will be resolved is just demographics in China really necessitate it. You look at the fallout from the one-child policy, you're seeing a very rapidly aging population in China. Case in point, 2017, you saw the lowest birth rate in China since 1961. This is really hampering China's ability to convert from a manufacturing-based economy to a consumer-driven economy like the U.S. So you have this, the aging demographics, and a trade war. It's causing havoc. So this is one of the reasons why we truly believe the trade war will be resolved sooner than most people anticipate, and we should come out on top.
And, there's also an impact on farmers here in the U.S. that we've been hearing a lot about, and in the manufacturing base as well. So it seems everything has this like a ripple effect, right? So, it's like putting a pebble in water and you watch the ripples sort of go out from there. And it makes people nervous. Does it ever make you nervous, Chief?
Yeah, it definitely does. I mean, there are some times where you see some market. You look at January 3rd of this year, I think the Dow Jones Industrial Average was down like 650 points. That makes you nervous because that's when investors are just running away, running out of the markets. But at the same time, though, the key point is that volatility is a normal part of the markets. And, you look at the, intra-year, I saw some stat that the average intra-year loss in the stock market is about 14%. So markets fluctuate all the time. But the key point is stick to your long-term investment objectives. And, sometimes you have to tune out the day-to-day news and you have to just focus on your longer-term, investment objective.
So, Gene, if you had a crystal ball, if you could see the future, I'm going to put you on the spot. If you could see the future, how soon would you predict that all of this is going to work itself out? I won't say come to an end, but I'll say work itself out.
when you say this, you mean what? There's lots of this. So which in particular, like the global economy or there's a lot going on. So I think let me,
yeah, that's true. So global economy, which really impacts everybody.
Yeah.
You know, and then
I think I fortunately I don't have a crystal ball, but what I do believe is that, you know, three things are going to help us. Number one, the trade war gets resolved. Number two, global central banks all over the world, U.S. and global, and the Fed and, you know, Bank of Japan, they are very much in a stimulative focus, and they're very much in a focus of either keeping interest rates where they are or lowering rates. I saw, you know, we did an analysis that there's, of the 26 major central banks, only three of 26 have raised rates in 2019. And the Fed has suggested that they will keep rates appropriate, and that suggests that they could cut rates if necessary given a trade war. So you have the Fed on your side, you have global central banks on your side. And the third point is economic data is still okay. You know, we're seeing it weaken a little bit, but still it's very expansionary, as I mentioned before. You know, again, case in point, unemployment rate is a 50-year low. That's pretty good news for the economy right now. So when will all this malaise shake out? It's hard to say. So, but I do hope sooner rather than later.
Wow. Well, yeah, it's a lot to think about. Thanks so much, Gene. My guest has been Gene Goldman, the Chief Investment Officer and Director of Research for Cetera Financial Group. Where can we go for some more information?
Sure. We have our firm's website is cetera.com, CETERA.com. Or, of course, you can always go to our Twitter feed. It's Cetera, CETERAIM for investment management on Twitter.
All right. Thanks so much for joining.
Audrey, thank you so much. Thank you for the opportunity to talk to you. Thank you.
My pleasure. And I'll be right back after this.
Okay.